This question examines transfer pricing in a decentralized organization and asks which method best motivates the manager of the selling division to produce efficiently. Transfer pricing is the internal price charged when one division transfers goods or services to another division within the same company. An effective transfer pricing system should promote goal congruence, managerial autonomy, and fair performance evaluation. Several transfer pricing methods exist. Market-based transfer price uses the external market price when a competitive market exists. Cost-based transfer price uses production costs, either actual or budgeted. Variable cost-based transfer price uses only variable production costs. Negotiated transfer price, determined through discussion between divisions. From a motivational perspective, market-based transfer pricing is generally considered the best method because it reflects an arm's-length transaction and rewards the selling division for operating efficiently. In contrast, actual cost-based methods can encourage inefficiency because higher actual costs can simply be passed on to the buying division. Even budgeted cost-based methods, while better than actual costs, provide weaker incentives than market prices. Thus, the question focuses on selecting the method that best encourages efficient production and accurate performance measurement. Cost-based transfer price that uses actual amounts. Incorrect. Using actual costs may reward inefficiency because higher production costs are transferred to the buying division. B. Cost-based transfer price that uses budgeted amounts. Incorrect. Budgeted costs provide better incentives than actual costs, but still do not reflect market value or opportunity costs. C. Variable cost-based transfer price that uses actual amounts. Incorrect. Variable cost pricing may not allow the selling division to recover fixed costs or earn a reasonable profit, reducing motivation. D. Market-based transfer price. Correct. A market-based transfer price provides the strongest incentive for efficiency because it reflects competitive market conditions and allows the selling division to be evaluated as if it were operating independently. Correct answer. D. Market-based transfer price. A market-based transfer price is the preferred method for decentralized organizations because it motivates efficient production, supports fair performance evaluation, preserves managerial autonomy, and aligns divisional decisions with the overall objectives of the company. This question tests your understanding of transfer pricing in a decentralized company. Morrison's Plastics division sells products to both external customers and internal profit centers. Normally, when a competitive external market exists, the market price is considered the best transfer price because it reflects the opportunity cost of transferring goods internally. However, an internal transfer price below the market price may be justified if the company avoids certain selling costs that would have been incurred on an external sale. Examples include sales commissions, advertising expenses, shipping costs, credit checks, and collection costs. Since these costs are unnecessary for internal transfers, the selling division can reduce the transfer price while still maintaining the same contribution margin as an external sale. Students should distinguish this situation from one involving excess capacity or full capacity. Excess capacity may allow a lower transfer price because opportunity cost is reduced, but the question specifically asks for a circumstance that justifies a price below the market-based transfer price. Avoidable selling and collection costs provide the clearest economic justification. A. The buying unit has excess capacity. Incorrect. The buying division's capacity does not affect the appropriate transfer price established by the selling division. B. The selling unit is operating at full capacity. Incorrect. When the selling division is at full capacity, it generally prefers to sell externally at the full market price because internal transfers involve an opportunity cost. C. Routine sales commissions and collection costs would be avoided. Correct. Internal transfers eliminate certain selling and collection expenses associated with external sales. Therefore, The selling division can accept a transfer price below the external market price while maintaining the same economic benefit. D. The profit center's managers are evaluated on the basis of unit operating income. Incorrect. Performance evaluation methods do not by themselves justify a transfer price below market value. Correct answer, C. Routine sales commissions and collection costs would be avoided. A transfer price below the market price is justified when internal transfers avoid external selling and collection costs, allowing the company to reduce the transfer price while preserving overall profitability and promoting efficient internal transactions. This question examines dual transfer pricing, an advanced topic in transfer pricing and responsibility accounting. Under a traditional transfer pricing system, the same transfer price is recorded by both the selling and buying divisions. However, this may create conflicts when the selling division wants a high transfer price while the buying division prefers a low one. A dual pricing arrangement solves this problem by allowing different transfer prices for the two divisions. For example, the selling division may record revenue at the market price, while the buying division records the transfer at a lower cost-based price. The difference is absorbed at the corporate level. Although this approach complicates accounting records, it can improve managerial incentives. The primary objective of dual pricing is to reduce conflict between divisions and encourage decisions that maximize the company's overall profitability rather than individual divisional performance. In other words, it promotes goal congruence, ensuring that managers cooperate instead of competing over transfer prices. Students should remember that dual pricing is used mainly for managerial performance evaluation, not for tax simplification or cost control. It provides an incentive for the supplying subunit to control costs. Incorrect. Cost control depends more on the transfer pricing basis, such as market or standard cost, than on the use of dual pricing itself. B. Exposes the supplying subunit to the discipline of market prices. Incorrect. This is an advantage of market-based transfer pricing, not specifically of dual pricing. C. Promotes goal congruence between the supplying and buying subunits of the company. Correct. Dual pricing reduces conflict by allowing each division to be evaluated fairly according to its own incentives, encouraging decisions that benefit the company as a whole. D. Simplifies tax calculations when the buying and supplying subunits are taxed in different jurisdictions. Incorrect. Dual pricing actually complicates accounting and tax reporting rather than simplifying them. Correct answer, C. Promotes goal congruence between the supplying and buying subunits of the company. The greatest advantage of a dual pricing arrangement is that it aligns the objectives of the buying and selling divisions with the overall objectives of the organization, reducing internal conflict and encouraging decisions that maximize total corporate performance rather than individual divisional results.